Hello traders. So the US dollar has extended its losses following the CPI report yesterday. We do have more inflation data coming up on Thursday, and ahead of it, we've seen the US dollar index extend its losses for the second session in a row, testing this trend line that has been in place since the dollar staged a recovery back at the start of July. So let's see if it will close today's session below this trend line. If it does, this will be a further bearish development. It has already broken support at 97.90, a level which is now going to be potentially resistance if it gets retested from underneath. If the trend line breaks, then the next key level to watch on the downside include this low right here at 97.10, which was hit in July before the dollar index staged this rally. Below that, the July low itself comes in at 96.37. In terms of resistance levels, I already mentioned 97.90. Above it, 98.50 is an important level to watch. Then 98.95. Because of the lower highs and lower lows, the part of this resistance on the dollar remains bearish and will only change if and when we get a clear bullish reversal signal. And for me, that would come in the form of a break above the 100 area, which is a massive level of support and resistance from the past. So if in the coming weeks we see a move above this area, only at that point the dollar index will have ended its bearish bias, unless of course we see a major reversal pattern at lower levels first. But as things stand, the path of least resistance is clearly to the downside, and the dollar could extend its losses against currencies where the central bank is a little bit more hawkish than the Fed, or those central banks where they're not expected to cut rates by much heading into the year end. And among them is the British pound, where the Bank of England last week was quite split in terms of deciding on that rate cut, which was narrowly passed. So as a result of that, we've seen the pound come back strongly in recent trade, and it has gone up nearly in a straight line in the last several days, as you can see on this daily chart. And from a technical point of view, there was a consolidation pattern, namely a falling wedge pattern, which was taken out a couple of days ago, with rates breaking the resistance trend of the pattern, and with that it has signaled renewed bullish momentum, and lo and behold, we are extending the gains seen starting from early this month, and now the currency pair is testing or approaching the most recent local high created on the 24th of July at 135.88 is the level to watch. Above it, we don't have any obvious levels of resistance apart from round handles like 137, and then thereafter the July high itself comes in at 137.88. But if it gets a wide stop there, why not go to 140, for example? So clearly we could potentially see some further significant gains in the cable given a positive macro backdrop, but a lot will depend on incoming data, both from the US and from the UK as well. From the UK, we have GDP data tomorrow, along with some other key economic indicators like industrial production, for example, whereas from the US, PPI will be in focus on Thursday, and then it will be the University of Michigan Consumer Sentiment and Inflation Expectation Survey on Friday, when we'll also have retail sales data to look forward to as well. Among the other major currency pairs, the Aussie dollar is looking quite interesting given a positive macro backdrop, with equity indices, for example, hitting multi-year highs or record highs in most cases, which is keeping a positive risk backdrop. And that's something that could support the Aussie dollar moving forward, which has shown some bullish characteristics as well. In terms of levels, then 65 was a very important level, which we broke through on the back of a big drop on this particular day. This level should have held as resistance if the trend was still bearish, but we broke through it and held above this week, suggesting that the path of least resistance on this currency pair is clearly to the upside. So from here, we could be heading towards the range highs as a minimum, I would say. at 66.25. There will be trapped traders stops resting above it. Obviously, there will be a couple of other levels to watch as we approach that level, including, for example, this level right here at 65.90-ish, which was resistance on a couple of occasions before we broke above it but didn't hold there. So that's an interim resistance, and if we go through that area, I think that would be a bullish development that could potentially pave the way for a run towards liquidity resting above the recent high. In terms of support, 65 is obviously a very important level now. Above that, we have this level right here at 65.40-ish, which was resistance on a couple of occasions, and we've broken above it today. So if rates can hold the breakout above here, moving forward, we could see any rounded retests of this level from above hold, potentially paving the way for more gains moving forward. The key line in the sand for me is if rates were to go below the 200-day moving average now in the coming days, and it's specifically this level right here at 63.72, which was the most recent low in this congestion zone before rates rally to new multi-month highs. If that level breaks in the coming weeks, at that point, I'll drop my bullish view on this currency pair. So it's possible, therefore, that we could see some further short-term weakness before the Aussie dollar takes off, but that's not the base case scenario for me. My base case scenario is that the Aussie will push higher without too much of a pullback in the existing range. For more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.